So good evening, everyone. I'm Nando. I'll be the moderator for this session. I'd like to welcome the members of the BizLink community. Thank you for joining this webinar on banking sector performance review for the year 2024. The purpose of this session is to observe the earnings of the banks and how to inform investor decisions. Then our facilitators are from the Faida Investment Bank. So we have Ngugi Waweru and John Collins Mbogwa. So I'll give Ngugi Wawero the chance to introduce Faida Investment Bank as he begins his session. So for the questions, kindly drop the questions in the chat box. We will facilitate our Q&A at the end of this session. So thank you all for joining. Ngugi, I'm making you the host.
No problem, Nandu. Thank you for the warm reception. My name is Ngugi Wawero from Faida Investment Bank. I'll be joined by John Collins today to run you guys through the bank earnings for 2024 and hopefully give you guys some insights into where we expect the banks to go and their performances for 2025. I'll be going first. I'll be running through KCB, Equity, I&M, Stanchart, and Cooperative Bank. So allow me to share my screen and we can begin.
Oh. Kwambia sasa zile mtu anajiulizanga kununua na kununua yenye ukitupikia which is cheap. Sasa unajiulizaje kujipikia? I think it's even more expensive juu ya makaa. No ni nyendaga kwigurira. Tondũ gwitũ rĩ mathimaga no nakombe karĩa kanini ga cuma tiga kĩrĩa gĩa kawaida gĩa 15. Kĩu gĩa cuma kĩendagio 35.
Sorry, Wangari Ndua, kindly mute yourself.
Jesus, I'm sorry.
Can we say happy birthday?
Now, question. So after I've just finished signing it.
And say happy birthday, baby.
But we are foregoing 1 million shillings in revenue.
One, please remember to mute yourselves once you join the Zoom.
Ngugi, how are you? Ngugi.
Ja, und das hat sehr lange gedauert. Wo ist der nur? Er sucht Emilien und Manuel. Nee, es ist zu spät.
Hello?
Yes, Ngugi, I was requesting, yeah?
Yes.
Because you are the host, you can always use your button to mute everyone, kindly.
Okay. Sorry.
Thank you.
I also realized I was muted, so I don't believe you guys heard me.
We couldn't even hear you. You were muted, we couldn't hear you.
Really?
You can always start. Okay.
1 second. Just give me 1 second. My comp is lagging. Apologies, 1 second. I'm having a problem with my computer. All right, can everyone see my screen?
Yes, the screen is shared there. Thank you.
So apologies, I was muted at the beginning, so let me start again. We'll start with Cooperative Bank, full year 2024 earnings. As of the date of this report, 24th March 2025, Corp was trading at 15.95 shillings. We expect it to climb to about 17.53, which is a 9.9% upside. Hence, we have given a buy recommendation. We expect it to be driven by its expansion strategy, improved subsidiary performance, loan book growth, and improved operational efficiency. In 2024, Coop recorded a 24.9% growth in total interest income to 86.2 billion. This was fueled by a 24.5% increase in interest income from loans and advances. This was despite a slight contraction in the loan book portfolio, resultantly due to higher rates. Interest income from government securities also increased by 16.2% to 26.9 billion, driven by increased holdings of government securities as well as improved yields. And additionally, interest income from deposits and placements with banking institutions surged by 225.9% to 3.5 billion. This is due to an increase in the deposits they have with banking institutions. I'm seeing some people saying they can't see my screen. Daniel, can you clarify that you can see my screen?
Yeah, I can see your screen. I don't know. Angela, can you see his screen now? Okay, good. Go proceed, Nani. Okay. Thank you.
Contribution was primarily on the back of loans and advances. We can see it was 65%. Government securities, 31%. The rise in interest income over the years is 55% from 2021. Interest expenses also increased by 45.7% to 34.7 billion. This surge was driven by a rise in interest on customer deposits of 60.9%, which is attributed to higher customer deposits and obviously the increased cost of funds. Interest on deposits and placements from banking institutions also declined, unfortunately, to 1.1 billion. Over the years, interest expenses have gone up by 137.7% between full year 2021 and full year 2024. As you can see, the contribution is primarily on customer deposits due to the cost of funds. As a result, the net interest income increased by 13.9% rising from 45.2 billion to 51.5 billion in full year 2024. And non-funded income, which is other income except from the interest earning assets, increased by 10.1%, reaching 29.1 billion from 26.5 billion in the previous year. And this was driven by a 56.4% surge in foreign exchange trading income. Overall, that saw the group's total operating income, which comprises both of net interest income and non-funded income, expand by 12.5% to 80.6 billion. Although due to the faster growth of net interest income compared to non-funded income, there was a decline in the non-funded income margin, which fell to 36.1%. Over the years, you can see the development of the net interest margin and non-funded income margin. So in 2024, the net interest margin was 7.6%, and the non-funded income margin was 36.1%. Operating expenses rose by 17.7% to 46.7 billion, and this was largely driven by loan loss provisions. However, if we exclude provisions, operating expenses grew by 13%, and this was mainly due to a 9.8% rise in staff costs, which climbed to 18.3 billion. And obviously, this was due to the expansion that the group is currently undergoing, which saw it open 27 new locations in the year and increase its workforce by 999 employees. Loan loss provisioning increased by 44.2% to 8.7 billion, which is a reflection of the prudent adjustment for a decline in asset quality that we're experiencing throughout the sector, the banking sector. Since operations grew at a faster pace than income, the cost-to-income ratio, including loan loss provisions, rose from 55.3% to 57.9%. But if we exclude provisions, it didn't rise as much. It rose marginally to 47.2% from 47%. And you can see the development over the years. And staff cost is their main contributor to operating expenses. The group's profitability improved by 9.8% with a PAT figure of 25.5 billion, driven by strong interest income growth. Regional subsidiaries, excluding Coop Kenya, they have Coop South Sudan, Kingdom Bank, their bank assurance and their trusts, and Kingdom Securities, contributed to 2.7 billion, which is an increase of 10.2%. To the PBT, which brought the group's profit before tax to 34.8 billion, up from 32.4 billion in the previous year. Kingdom Bank, in which Coop owns a 90% stake, recorded a 5.8% decline in PBT, unfortunately falling to 1.0 billion in full year 2024. Coop Trust Investment Services posted a robust performance, with its contribution climbing by 71% to 386.4 million from 226 million in the full year 2023. And this growth was mainly on the back of an increase in assets under management, which climbed from 218.3 billion to 381 billion. However, overall profitability was partially affected by Coop South Sudan, where its contributions declined 96.2% from 11.1 million to 11.1 million from 291.3 million in the previous year. And this is largely due to adjustments for hyperinflation. And earnings per share rose in line with profitability to 4.34 in 2024, and the group declared a dividend of 1.5 for the year, which they maintained the same level as FY23. In terms of the balance sheet, the total asset base expanded by 10.7%, reaching 743.2 billion. As we said, holdings of government securities increased by 15.1% to 71.6 billion, and the loan book experienced a marginal contraction of 0.1%. On the other hand, customer deposits grew by 12.1%, and with deposits outpacing lending, the loans to deposit ratio declined from 82% to 73.4%. Asset quality, which has been a challenge across the industry, also happened to affect Coop Bank, as the lender recorded a 6.2% increase in its non-performing loans, and the LPL ratio increased to 16.8, up from 16.1 in the previous year. While Coop Bank Kenya increased to 16.6, which is above the 16.4 average as of December 2024. It's above the 16.4 industry average. So it's a question of decaying asset quality, and Coop on the call did address some of the concerns we had in regards to that, but I'll mention that in the outlook. Among the sectors, building and construction have the highest NPL ratio of 47.5%, with real estate not far behind at 41.4%. However, NPL coverage remains strong at 69.2%, and the bank's target is about plus or minus, is around 70% plus or with an estimate. Coop's profitability was supported by high interest income and is a trend that is expected to continue. While the bank faces challenges from deteriorating asset quality, its credit management system, MS strategy, and risk-based pricing model are expected to support improvements, with Coop aiming to reduce its NPL ratio to approximately 15% in the next financial year. This is what they told us on the call. The lender continues to advance its digital strategy, with 92% of transactions now conducted through alternative channels. Coop's growth is expected to drive its aggressive expansion strategy, improve subsidiary performance, loan book growth, and operational efficiency. In its investor briefing, as I said, the lender outlined plans to expand its loan book by about 7%, increase deposits by 10%, and grow PBT at a similar rate. They're implementing their Soaring Eagle. They've implemented the Soaring Eagle transformation, and their 2025 strategy, Good to Great Corporate plan, targets growing the bank's asset base beyond 1 trillion, with the key objectives of this strategy including strengthening market dominance in Kenya, leveraging digital innovation for increased efficiency, and ensuring a seamless customer experience across all touchpoints. So that's basically what we have for Coop. Let me move on to our next bank. All right, I hope you can see my screen. Next, we'll move into Equity Group earnings for 2024. As of the date of this report, the price was 47.1 shillings. We expect it to go to 55.3, which gives you an upside of 17.5%. Hence, our recommendation stands at buy. We expect the performance to be accelerated by its continued expansion, its diversification, and the performance of its subsidiaries, which will hopefully continue to cover for the slowdown in the Kenyan unit as the Kenyan unit continues to recover. Equity Group recorded a 9.2 increase in total interest income, which saw it rise to 170.3 billion. The growth was fueled by a 5.3% uptick in interest income from loans and advances. This being the largest contributor to total interest income. Interest income from government securities also posted a strong 9.9% increase, again due to the improved yield seen throughout the year. Interest income from deposits and placements with banking institutions, again also surged by 194.7%, underscoring the strategic deployment of excess liquidity in high-yielding placements. As you can see, over the years, the development in interest income has gone up by 80.6%, which is well welcome. And we can see loans and advances continue to be the main contributor to interest income. Interest expenses also climbed by 20.3%. This was primarily driven by a 45% rise in interest expenses on customer deposits, which again reflects the higher funding costs that commercial banks have been experiencing throughout the year. And we can see over the years from 2021 to 2024, there's a climb from 25.5 billion to 61.5 billion. Again, as tends to be the trend, customer deposits are the main contributor to interest expenses within banks. Net interest income grew by 3.7%, despite the faster rise in interest expenses compared to interest income, with non-interest income expanding by 10.7% to 85.1 billion, largely driven by a surge in other income, which surged by 63.2%, climbing from 10.5 billion to 17.1 billion. Forex trading income declined by 27.5%. This was a reflection of weaker performance in the currency trading activities within the bank. As a result, the total operating income comprising of net interest income and non-funded income rose by 6.7% to 193.8 billion. The stronger growth in non-interest income compared to net interest income led to an increase in non-interest income margin, rising to 43.9%, and net interest margin declined to 7.1% from 7.4% in the year before, which is reflective of pressure on interest spreads. So we can see the development in full year 2021. The net interest income margin was 69.7%. The non-interest income margin was 69.7%. It's declined to 43.9%. So majority of the income is now coming in through interest earning assets. Operating costs and provisioning. We see the group's total operating expenses, including provisions, rose by 2.5%, up from 129.8 billion in the previous year to 133 billion in the current year, in the FY24. Excluding provisions, however, operating expenses surged by 19.8% to 112.9 billion. This is reflective of an increase in underlying operational costs. As has been the trend, loan loss provisioning costs, this is against the trend, the loan loss provisioning costs declined by 43.3%, likely indicating a shift in risk management. I know the bank has mentioned that they tend to be a bit more aggressive in their in their recovery efforts. So that is probably why they decided to reduce their provisioning. The cost to income ratio, excluding provisions, increased by 58.2%, up from 58.2%, up from 52.3%, signaling again the elevated operational expenses. However, when we factor in provisions, the ratio improved to 68.7%, down from 71.3%, as lower provisioning expenses have offset the rising costs. In terms of profitability, the profit before tax grew by 17.1% to 60.7 billion, while within the banking segment, the regional subsidiaries contributed 54% of total PBT. Equity Bank Kenya still remains the main driver of the banking business, contributing 46% to PBT. Overall group profitability rose by 11.6%, with a PAT of 48.8 billion, with the regional subsidiaries playing a significant role again, contributing 50% to the banking segment's profit after tax. When I say banking segment, I mean excluding the group's insurance business or any other business. So the other 50% was contributed to by the Kenyan outfit. You can see the main growth in PAT was in Equity Bank Uganda, which experienced a 186% growth in PAT contribution, with followed by Equity Bank Tanzania. Unfortunately, Equity Bank Kenya and South Sudan reported declines as they have faced a few headwinds. In terms of balance sheet, the asset base saw a marginal decline of 0.9%. The loan book contracted by 7.7% to 819 billion, which has been driven by reductions in portfolios in the Uganda and Tanzania subsidiaries. And notably, Equity Bank South Sudan was the only subsidiary to record loan book growth. Investments in government securities were surprisingly muted compared to some of the other banks, only edging up by 2.3% to 512 billion, while customer deposits expanded by 3% to 1.39 trillion, despite declines in deposit levels across Tanzania, Rwanda, Uganda, and South Sudan. With deposits growing at a faster pace than loans, the loan deposit ratio declined to 58.5% from 65.4% in the year before, which is reflective of a more cautious lending stance, as well as muted demand for loans. In terms of asset quality, the non-performing loans ratio increased to 12.2%, up from 11.7%. Equity Bank Kenya reported the highest NPL ratio of 17.4%. As I said earlier, the industry average is 16.4 as of December. So this is a point of concern. But gross non-performing loans also grew by 6.5% to 122 billion, with NPLs mainly being concentrated in the corporate and large enterprise loan segment, which posted an NPL ratio of 22.4%, followed by the MSME segment posting 13.5%. As we can see, Equity Bank Kenya leads the NPL ratios by country, followed by Equity Bank Uganda, and the lowest ratio on that list happens to be Equity Bank South Sudan. For our outlook, we expect Equity to continue focusing on diversifying its books, with its insurance arm demonstrating continued growth. Profit before tax on its insurance arm climbed by 58%, from 934 million in FY23 to 1.5 billion in FY24. I apologize for that error. Although insurance service revenue did decline by 13% due to a reduction in credit life premiums, which was driven by slower loan book growth at Equity Bank Kenya. Although despite the dip in these premiums, the insurance segment is quite vast, and with Equity expanding into different regions as well, we expect it to continue to be a driver of income, as well as continue to grow steadily. Following the adjustment by the CBR on the rate, the Equity Bank Kenya has adjusted its lending rates accordingly, and this is expected to spur loan book growth. And in light of that, the lender on their call anticipates a growth of approximately 7.5% to 12.5% in the coming financial year. Its NPL ratio, as I said, stands at 17.4%, which is above the industry average. They have made it a point to improve their recovery efforts, although this might take time, as various matters either go to court or have their own issues in terms of recovery. The costs, as I said, are high, and this is also another point of concern, though Equity has assured investors that they intend to lower this, although I do not see it being as instant as they may like due to ongoing investments in staff, automation, and their diversification in insurance and other arms, it might take a bit longer to drop to a level that they believe would be sustainable. On to the next one. 1 second. Next, I'll be going into the I&M Group's full year 2024 earnings highlights. At the time of this report, the 26th of March 2025, the price was 33.15, and we expect it to climb to about 37.99 shillings. This is a 14.6% rise, and hence we endorse a buy. This was driven by the group's Imara 3 strategy, and expanding customer deposits and the growth of its loan book through its continued innovation in product offerings. I&M Group recorded a 35% increase in interest income, rising to 68.1 billion. The growth was largely fueled by a 32.3% surge in interest income from loans and advances, which climbed to 48.3 billion. Interest income from government securities also expanded by 38.6% to 16.1 billion. And this growth was driven by increased investment in government securities, as well as higher yields throughout majority of the year. As you can see, interest income has grown by 151.3% between 2021 and 2024, and the main contributor continues to be loans and advances. Mirroring the trend among Kenyan commercial banks, interest expenses climbed by 39.9% to 30.5 billion, and this increase was largely driven by a 44% jump in interest expenses on customer deposits, again due to the higher funding costs, even though they had a slowdown in their deposits. Additionally, interest on deposits and placements from banking institutions recorded a 49.1% increase, climbing to 3.5 billion. As we can see, interest expenses have climbed by 208.1% between 2021 and 2024, and majority of this continues to be from customer deposits. Net interest income grew by 31.2%, reaching 37.6 billion. In contrast, the non-funded income declined by 2.8% to 13.7 billion from 14.1 billion, with Forex trading income seeing a sharp 34.6% decline, and fees and commissions from loans and advances declining as well by 5%. As a result, the non-funded income margin dropped from 32.9% to 26.7%, which reflects a reduced contribution of non-funded income to the total operating income. Moreover, the group's net interest margin climbed to 7.2% from 6.6%. However, despite this growth, the net interest income offset the weaker non-funded income performance, driving total operating income up by 20% to 51.2 billion. So operating income over the years has gone up by 111.6%, and the main contributor to non-funded income is other fees and commissions. Operating expenses, including provisions, also climbed by 15.2% to 31.3 billion. Excluding provisions, operating expenses grew by 15.7%, while provisions for loan losses rose by 13.8%, reflecting a strategic shift to cushion against continued asset quality decay. Staff costs increased by 21.3%, and this was driven by the bank's expansion push as it aims to strengthen its retail banking segment. And other operating expenses, the largest contributor of total expenses, expanded by 18.1%, from 9 billion to 10.6 billion. In terms of efficiency, the cost-to-income ratio improved, declining from 47.6% to 45.9%. Although it's increased from FY21's 39.7, we see that it has decreased from FY23's, and you can see the trend throughout the years. Group profitability, the group posted a profit before tax of 19.9 billion in 2024, representing a 28% increase from 15.4 billion in the previous year. The contribution of the subsidiaries to profit before tax rose by 29%, up from 24% in the previous year. Excluding Kenya, I&M Rwanda led with a 15% contribution, followed by Tanzania at 5%, while I&M Kenya remains the main driver, accounting for 71% of the group's profit before tax. Similarly, the PAT grew by 24.8% to reach 16.7 billion, and this performance underscores the group's resilience and operational efficiency despite the economic landscape. Earnings per share increased to 9.3 shillings, up from 7.63 in the previous year, while dividend per share rose to 3 shillings, up from 2.55 in the previous year. Over the years, we can see profit after tax has grown by 125.7%, and the dividend and earnings per share are on a steady climb, going from 1.50 per share to 3 shillings, as well as the earnings per share from 4.92 to 9.3 between 2021 and 2024. In terms of the balance sheet, the asset base grew marginally by 0.3%. The loan book portfolio contracted by 7.8%. And however, the group, as you can see, took advantage of the interest of the yields on government securities, expanding its holdings by 40.2%. However, customer deposits decreased by 1.1%. This led to the loan-to-deposit ratio falling to 69.6% from 74.7% in the previous year. On asset quality, the gross non-performing loans ratio increased to 12.4%, up from 11.4%. You can see it's been a steady rise over the years. So we expect I&M's growth to remain anchored on its Imara 3 strategy, which has focused on expanding its offerings and enhancing digital transformation, and deepening its market penetration, both in Kenya and regionally. The introduction of unsecured personal loans is set to accelerate loan book growth, as well as the decline in interest rates stimulates credit demand. Operating expenses continue to remain elevated, which we believe is driven by the bank's aggressive expansion initiatives and continued investment in digital infrastructure. While these expenditures do position the lender for long-term competitiveness, it does affect their books in the near term and increases some pressure on their profitability. However, the subsidiaries have exhibited consistent and robust financial performance, and we expect this to continue. That said, we remain cautious about compression in the net interest margins, as declining interest rates could weigh on interest income generation, and the bank will need to obviously leverage other revenue streams and optimize on cost efficiency to mitigate this impact. Allow me to move on again to my next bank. Right. Next, we have KCB Bank. I hope you can see my screen. KCB, as of this report, was trading at 42.15 shillings. We expect it to climb to 48.37, which is a upside of about 14.76%. And this will be driven by top-line expansion by its regional subsidiaries, diverse product offerings, and strategic investments in both technology and keeping costs in check and improving their digital banking solutions. KCB Group recorded a 26.9% increase in interest income, which is a climb from 168.2 billion to 213.4 billion. The largest contributor to interest income was from interest income on loans and advances, which grew by 26.3%, up from 12.1 billion the previous year to 153.6 billion in full year 2024. And this growth persisted amid sluggish private sector credit demand, which demonstrates the sheer size of the lender's loan book and the effective credit management strategy. Meanwhile, interest income from government securities also rose by 17.6% to 50.2 billion, supported by higher yields and the bank capitalizing on these yields by increasing their holdings of government paper. We can see over the years, interest income has grown by 64.6%, from 102.2 billion in full year 2021 to 213.4 billion in full year 2024, with the main contributor remaining loans and advances. Interest expenses rose by 25%, reaching 76.1 billion. This was primarily on higher costs associated with servicing customer deposits, which is a reflection of the elevated interest rate environment experienced last year. Interest paid on customer deposits jumped by 32.5% to 55.4 billion, although this spike occurred despite a slowdown in customer deposits, which underscores the intense pressure from rising funding costs as depositors sought higher returns in a tightening monetary environment. Over the years, we've seen that interest expenses climbed by 210.9%, from 24.5 billion to 76.1 billion. The main contributor to this remaining customer deposits. The group's net interest income margin surged by 28% to 137.3 billion. This growth was supported by higher asset yields, driving the net interest margin, which is a measure of how much the bank earns on interest on assets relative to what it pays out, to 7.6% from 6.6% in the previous year. Non-funded income rose by 16.6% to 67.5 billion. This increase was primarily fueled by a 61.7% surge in forex trading income, which jumped to 17.5 billion from 10.8 billion the year prior. Other fees and commissions, which were the largest component of non-funded income, grew by 14% to 30.8 billion. And this, as a result, saw the group's total operating income climb by 24% to 204.9 billion. However, the faster growth in net interest income relative to non-funded income caused the non-funded income margin to edge down to 33% from 35% in the previous year, which reflected the group's stronger reliance on interest-driven earnings. As we can see throughout the years, the non-funded income margin has dropped from 39.8% to 33.0% currently, while the net interest margin remains fairly unchanged between 2021 and this year, and marginally between 2022 and 2024. However, we see a welcome 1% rise between 2023 and 2024. KCB recorded a modest 5.2% rise in operating expenses, this being inclusive of provisions, which reached 122.9 billion. Excluding provisions, the operating expenses grew by 11.8%, climbing to 92.9 billion. Staff cost remains the largest contributor to this, which climbed by 4.5% to 39.5 billion. And this subdued climb is on the back of a decrease in employees, as it appears that KCB reduced the size of the staff. Despite the rise in expenses, the cost-to-income ratio, excluding provisions, improved to 45.4%, down from 50.3%, which signals enhanced operational efficiency, which are arguably the effects of increased investment in technology, which has improved the process optimization. As you can see, over the years, operating expenses have climbed by 156.9%, from 47.8% in full year 2021 to 92.9 billion in the current year. The staff costs obviously remain the largest contributor, followed by loan loss provisions and other operating expenses. KCB Group's profitability saw a surge of 64.9%. I know many of you have questions as to why the PAT would surge so much and the dividend payout was not what was expected. We also were puzzled by that, but we believe that the bank either intends to reinvest this money or the sale of NBK is not 100%, so they'd rather hold on to some cash. This impressive growth was fueled by expansion in earning assets and the implementation of a risk-based pricing model, which helped offset a sharp rise in interest expenses. Enhanced operational efficiency helped operating income outpace expense growth, which boosted the JAWS metric, which is reflects the difference between revenue and expense growth, to 12.2%, up from a negative 19.1% in full year 2023. The group's regional subsidiaries outside of KCB Bank Kenya remain key contributors, accounting for 30.3% of the PAT. However, this was a decline from 35.1% in the previous year. And this was due to exceptional performance by KCB Kenya. Despite the reduced contribution percentage, PAT from subsidiaries outside Kenya grew by a remarkable 42% to 19.6 billion. KCB's investment bank and asset management arms also delivered standout results, with profits soaring by 105% and 70%, closing at 203 million and 73 million respectively. And reflecting the strong bottom line performance, the earnings per share rose to 18.7 from 11.6% in full year 2023. And in a positive turn for shareholders, KCB resumed dividend payments, declaring a 3 shilling dividend per share, following a pause in the previous year. So over the years, we've seen PAT climb by 80.8%, from 34.2 billion to 61.8 billion. And subsidiaries now contribute to 30.3%, KCB Kenya providing the balance. This is KCB's total asset base contracted by 9.6% to 2 trillion. This was down from 2.2 trillion the previous year. The decline was primarily driven by a 9.6% reduction in the group's loan book, which settled at 990.4 billion from 1.1 trillion in the year before. And this was due to the impact of a stronger shilling, which reduced the value of foreign denominated loans. In contrast, holdings in government securities grew by 2.9% to 408.9 billion. And this increase pushed the ratio of government securities to total assets to 20.8%, up from 18.3% in the year prior, as the lender aimed to capitalize on the higher yields and safer asset classes. On the funding side, customer deposits dropped by 18.3% to 1.4 trillion from 1.7 trillion. And this decline again was influenced by the strengthening of the shilling, which impacted foreign currency deposits, and alongside the deconsolidation of National Bank of Kenya. And additionally, KCB ceded a market share on the G2G deal, which further affected the deposit base. Despite this, the deposits from subsidiaries outside KCB Bank Kenya increased their contribution to 34.3% from 33.8% in the year prior. With loan growth outpacing deposit mobilization, the loan-to-deposit ratio climbed to 71.7%, up from 64.8% in the previous year, which underscores the shift in the bank's funding and lending dynamics. KCB Group continues to grapple with the rising non-performing loans as the gross NPLs climbed by 8.4% to 225.7 billion, up from 208.3 billion the previous year. And this increased the group's NPL ratio to 19.2 percent, up from 18.5% in the previous year, which is well above the 16.4 industry average. So that is a key point of concern for KCB. At the subsidiary level, the highest NPL ratios were recorded by National Bank of Kenya with 33.7%, followed by KCB Bank Kenya at 21.8%, highlighting the concentrated risk in key domestic segments, while KCB Bank Burundi and KCB Bank Tanzania reported the strongest asset quality ratio with ratios of 1.5% and 1.4% respectively. Although KCB's NPLs have risen, the loan book remains fully covered through a combination of cash provisions as well as collateral. By sector, we can see building and construction again leads the way at 60.5%, followed by trade and real estate at 33.5% and 29.1% respectively. With interest rate declining, we anticipate that KCB Group's revenue will be bolstered by higher interest income driven by increased lending to customers. However, we cannot say to what extent this growth will be, as loan uptake is difficult to predict. The sale of KCB subsidiary National Bank of Kenya has faced some setbacks, primarily due to regulatory challenges involving the buyer Access Bank Nigeria and the Central Bank of Nigeria. Access Bank was required to divest from its DRC operations before finalizing the acquisition, which it has yet to do. It was also supposed to reanalyze its UK operations, and this has caused delays in the sale completion. However, during the investor briefing, Paul Russo assured investors that the bank has a contingency plan in place should that deal fall through. NBK's price tag is set at 1.25 of its current book value, positioning the anticipated sale proceeds at approximately 16.2 billion based on its 2024 December financials. KCB has made significant investments in technology, and this has seen efficiency improve. It continues to do so, and we expect the JAWS metric to continue to remain positive. Given the current economic climate, NPLs remain a key challenge for the group. However, the planned divestment of NBK, which is the largest contributor to NPLs, is expected to improve overall asset quality. And on to my final bank before my colleague takes over. So for my final bank, I'll be looking into Stanchart Bank. As of the time of this report, 20th March 2025, the bank was trading at 304.25. We expect it to climb to about 320.16, which is a 5.23% upside. As such, we recommend a hold. We are confident that the growth trajectory will be reinforced by strategic investments in technology, which will improve efficiency, a well-diversified revenue base, which has helped mitigate concentration risks, and a strong return on equity underpinned by prudent financial management. The revenue performance as of full year 2024, the bank experienced a 20% rise in interest income, reaching 38.8 billion. The growth was driven by a 25.9% climb in interest from loans and advances, which climbed to 22.8 billion. Interest income from government securities also climbed by 18% to 9.8 billion, which again is on the back of expanded portfolio and improved yields. Meanwhile, interest income from deposits and placements with banking institutions saw a modest growth of 4.6%, which saw it climb to 6.2 billion. Over the years, we can see interest income climbed by 74% from 22.3 billion in full year 2021 to 38.8 billion in the FY 2024. The main drivers we have seen across all the banks is loans, interest income from loans and advances. Interest expenses surged by 83.4%, which was quite a surge from 5.6 billion, up to 5.6 billion from 3 billion the previous year. And this was mainly fueled by a rise in interest expenses on customer deposits, which jumped from 4.6 billion to 4.6 billion from 2.6 billion, which aligns with the rising cost of funds driven by the tight monetary policy observed earlier in the year. Other interest expenses and interest on deposits and placements from banking institutions also saw growths of 175.6% and 94.7% respectively, which saw them close the period off at 721.9 million and 300.4 million. This marked a significant increase from 262 million and 154.3 million the previous year. We've seen now development in interest income. Over the years, it has climbed by 43.6% from 3.9 billion to 5.6 billion. Again, the main contributors we have seen across the banks is customer deposits. Net interest income expanded by 13.4% to 33.3 billion, up from 29.3 billion the previous year. And this was fueled by higher client assets, increased investments in money markets, and improved margins, while non-funded income posted a robust 40.4% surge, reaching 17.4 billion. And this was largely driven by a turnaround in other income, which swung from a 2.0 billion loss in full year 2023 to a gain of 2.5 billion, marking a 224.4% improvement. Additionally, other fees and commissions rose by 13.8%, and forex trading income, which was the largest component of non-funded income, dipped by 2.1% to 8.3 billion from 8.4 billion in the previous year. As such, the group's total operating income, which is a combination of net interest income and non-funded income, climbed by 21.4% to 50.7 billion. With non-funded income growing at a faster pace than the net interest income, the non-funded income margin improved from 29.7% in 2023 to 34.4% in 2024. And the net interest margin strengthened to 15%, with the bank making the most of attractive yields on the government securities. The lender's profit before tax surged by 43.3% to 28.2 billion in FY24. Enhanced operational efficiency drove an improvement in the JAWS metric, which is an indicator of the gap between revenue and expenses growth, to 13%, up from 3% in the previous year. Group profitability was even stronger, the PAT growing by 45% to 20.1 billion from 13.8 billion the year prior. Earnings per share climbed in tandem with profitability, rising to 52.65 shillings from 36.17 the year prior, in the prior year. In line with this performance, the lender declared a total dividend of 45 shillings per share, inclusive of the interim dividend, marking a substantial 55.2% increase from the dividend per share of 29 shillings in 2023. As we can see over the years between 2021 and 2024, dividend per share has gone from 19 shillings to 45 shillings, which is remarkable growth. And we've seen the PAT has gone from 121.8%. It has grown by 121.8% from 9 billion to 20.1 billion. In terms of operational efficiency, we saw a 1.6% uptick in the operating expenses, including provisions. If you exclude provisions, these expenses rose by 7.3%. Staff costs is the largest contributor, which saw a notable 15.1% increase to 9 billion, up from 7.8 billion the year prior. The lender scaled down its provisioning by 29.6%, in fully reflecting a reduction in non-performing loans. Despite the rise in expenses, the cost-to-income ratio, including provisions, improved significantly, declining to 44.2% from 52.9% in full year 2023. Excluding provisions, the ratio declined to 39.6% from 44.8%. And this efficiency gain was driven by robust growth in operating income. So we can see that the cost-to-income ratio has gone from 50.1% in 2021 to 45.6% in the next year. It climbed to 52.9% in 2023 and has dropped to 44.2% in 2024. In terms of the balance sheet, the total asset base contracted by 10.3%, the loan book declining by 7.1%, settling at 151.6 billion. I'm seeing that we have a problem with this slide. Let me share again. This is a slide, okay. So as I was saying, the loan book declined by 7.1%, settling at 151.6 billion. Holdings government securities surged by 42%, where the lender's total exposure to the Central Bank of Kenya, along with government and other securities, grew by 17.1% to 127 billion, up from 108.5 billion the previous year. Customer deposits fell by 13.8%, dropping from 342.9 billion to 295.7 billion. And this was due to the strengthening of the shilling against the dollar, which affected foreign currency deposits, as well as shifts by clients toward the alternative wealth investments. As a result of a sharper decline in customer deposits relative to the loan book, the loan deposit ratio rose from 47.6% to 51.3%. And contrary to prevailing industry trends, Stanchart recorded a 30.2% decline in non-performing loans, which dropped to 12 billion from 17 billion. This saw the group's NPL ratio improve to 7.4%, which is well below the industry average of 16.4%, and a notable reduction from 9.7% in the year prior. Our outlook for Stanchart, we expect it to continue to be driven by strong gains in its non-interest income, driven by its bond trading activities and wealth management division. However, the prevailing decline in interest rates, we expect Stanchart's margins to face some pressure, while the lender's risk-based pricing model has remained resilient. The reduction in the CBR is expected to weigh on its net interest margin, particularly given its already low funding costs. Furthermore, with clients increasingly shifting towards alternative investments, we expect muted growth in the lender's customer deposits. However, this trend is expected to drive strong expansion in its wealth management unit. And the bank has a few ongoing court cases which are of concern. It is currently facing a long-standing lawsuit from former employees demanding their pension dues, with the pensioners seeking 9 billion as a payout, as well as a 34-year-old legal dispute with Manchester Outfitters, who are seeking 33 billion. Stanchart is already on the back foot in regards to the pension case, as the High Court ruled in favor of the pensioners. And the bank went to the Court of Appeal and suffered another setback as the Court of Appeal held the decision. So these are quite large numbers, and they will significantly affect the profitability of the bank if the oil does not go their way. Hence, we have adopted a wait-and-see attitude, hence our recommendation of a hold. And as we wait to see how these court cases go and how the transition to the wealth management in terms of shifting client trends continues to develop. I'll now hand over to my colleague, John Collins, who will run us through the remaining banks. And we'll have a Q&A after where we'll answer all the concerns and questions you may have. Thank you.
Thank you so much, Ngugi. Just a minute as I share my screen. I think the host should allow me to share. All right. I hope my screen is well visible.
Yes, it is.
All right.
Yes, it is.
So I'll be taking you through. Pardon, Daniel?
Yes, the screen is shared. We can hear you very well. Continue.
All right. Thank you. Thank you so much, Daniel. So my name is John Collins Mugwa. I'll be taking you through Stanbic, NCBA, and Absa Bank. So first and foremost, let's deal with Stanbic Bank Kenya. For the Q4 2024 earnings, we have the normalized share price movement of Stanbic Bank versus the market and other banking peers in Q4 2024. You've probably seen in my colleague's presentation. He just tries to depict how the share price has been performing in comparison to the other bank stocks, as well as the NSE All Share Index, which covers the entire exchange. All right. So as of 13th March 2025, which when the price was 160, our valuation estimate is currently 180 shillings, giving us an upside of 12.5%, and thus our recommendation of a buy. We recommend a buy on Stanbic Bank with a fair value of 180 shillings, representing an upside of 12.5% on the 13th March 2024, closing price of 160. Due to the fact that the bank is well positioned for growth, supported by strong asset quality, low NPL ratio, and prudent cost management. Additionally, the expansion of its bank assurance segment is expected to enhance revenue generation, positively impacting overall profitability. So let's proceed now into the numbers. And we see the interest income and non-interest income. So we see that net interest income fell by 5.1% to 24.3 billion in fiscal year 2024, down from 25.6 billion in the previous year, primarily driven by the elevated cost of funding amid a high interest rate environment. And interest revenue remained relatively stable, registering a slight decrease of 1.7% to 15.4 billion from 15.7 billion. As a result, total operating income dropped by 3.8% to 39.7 billion in 2024 compared to 41.3 billion in 2023. To my right, you can see the net interest income and non-funded income. And you can see that in 2023, we had net interest income of 25.6, and then we dropped to 24.3. All right. So next, I think the reason why we actually cover this interest income and unfunded income is you want to see the extent to which interest rates actually affect banks' revenue, because you also want to see the non-funded income actually taking a good chunk, because when now the interest rates are down as we see currently due to the easing policy by the Central Bank of Kenya, you want to see that because it's expected that the net interest incomes will actually dip, But now we also want to see the non-interest income, the non-funded income, actually playing a part to just offset the decline in net interest income. All right. So next we have the credit impairment charges. For Stanbic Bank, we don't have so much to talk about, but Stanbic Bank recorded a 50.3 decline in credit impairment charges, reducing from 6.2 billion in 2023 to 3.1. This improvement was driven by proactive customer engagement and favorable FX impacts. The reduction in credit impairment helped mitigate the decline in operating income. Just a minute. Okay, I'm getting news that I'm not very visible. Let me just try and sort that out. Kindly advise whether this is better.
Yeah, that should be better. Thank you.
All right, thank you. So as I was saying, on the credit impairment charges, Stanbic recorded a 50.3 decline, which is quite huge in credit impairment charges, reducing from 6.2 billion to 3.1. This improvement was driven by proactive customer engagement and favorable FX impacts. This helped mitigate the decline in operating income, ultimately leading to an year-on-year growth in the bank's bottom line, because a reduction of roughly 3 billion, you will definitely see it on the bottom line. Income after impairment charges was up 4.5% to 36.6 billion in 2024 from 35.1 billion in 2023. You can see now the credit impairment charges development over the years. 2021 we had 2.5, increased to 4.9, then 6.1, and then now the drastic 50.3% decline in 2024. All right, on to operating expenses. Operating expenses remained largely stable, contracted by a modest 1.7. That's a really small, contraction to 17.7 billion in 2024 from 18 billion in 2023. This was driven by base effects, currency appreciation, and the bank's ongoing focus on operational efficiency. So the cost-to-income ratio, after deducting the loan loss provision, worsened by 1 percentage point, rising to 44.5% in 2024 from 43.5% in 2023. So this decline was driven by a faster drop in operating income, while operating expenses remained relatively stable. So I assume that if you have any questions concerning some of these terms, you will ask us during the Q&A. So we'll just proceed. Bottom line, which basically talks about profitability. Profit before tax grew by 11% year-on-year, rising to 18.97 billion in 2024 from 17.09 in 2023. After tax, the net profit increased by 12.8 to 13.7 billion from 12.2 in the previous year. Comprehensive income increased to 13.2 billion in 2024, up from 12.2 billion in 2023. Earnings per share, which is a metric that shareholders really like to look at, grew in line with the group's profitability, rising by 12.8, similar just to the net profit growth, to 34.7 in 2024. From 30.75 in 2023. Additionally, the board of directors proposed a final dividend of 18.9, which is something that was very celebrated by shareholders, in addition to the interim dividend of 1.84, bringing the total dividend for the year 2024 to 20.74. This 20.74 marks a 35.1% increase from the 15.35 that was paid out in the previous year, which is 2023. You can see there the earnings per share development from 2021. It's been an uptrend, which is actually quite good, giving us expecting now in this year 2025 more or less, we should see the same thing. But as we usually say, past performance is not a guarantee of future results. So you have to keep that in mind. Dividend per share as well, uptrend. Subsidiary performance. Stanbic Bank Kenya delivered a strong performance in 2024, posting a profit of 13.5 billion, a 17% increase from 11.5 billion in 2023. Right. So actually, to the right, you can see the Stanbic Bank Kenya actually contributes the largest. That is quite obvious. In contrast, Stanbic South Sudan's net profit dipped by 61.7 to 176 million from 460 million. Quite a drastic decline of 284 million, largely to the escalating political instability in the country, as you're all aware. Most of these things. That's why it's very important to just keep tabs with the geopolitical issues that are taking place, because they will definitely appear on the books. Stanbic Bank Assurance Intermediary Limited also faced a downturn, with profits falling 18.7% to 174 million from 214 million. Meanwhile, SPG Securities saw a sharp decline in profitability, dropping 86.7 to 20 million from 150 million. Consider the Kenyan operations, which is now the main revenue contributor. You can see it's definitely an uptrend, showing a lot of resilience from the Kenyan subsidiary. All right, and over to the balance sheet. Total assets remain steady, dropping by a modest 1%. That's quite negligible. Loans and advances to banks. This is more or less the loan book. Declined 17.3% to 294.7 billion from 356.2 billion. The drop was primarily driven by the high interest rate environment, which constrained private sector credit growth, which is something that has been on a decline the entire 2024. So that is actually, as the CK is cutting rates, this is one of the areas that they're looking at. This is one of the metrics that they actually focus on. And so as they cut rates, they expect that private sector credit growth should actually now make a rebound, and people will just take more loans, and we should see that growth make a comeback. Over to customer deposits, which declined by 2.4 to 339 billion from 347.2 billion. Total liabilities were reduced by 2.9% to 379.4 billion from 390.7 billion. Shareholder funds grew by 10%, which is a good thing, to 75.4 billion, up from 68.6 billion, which is an increase of 6.8 billion, which that's quite commendable. You can see the trend in the loan book and as well as the customer deposits, which are the two main metrics when you're looking at a bank. The deposits and the loan book as well. You can see the loan to deposit and loan to asset ratios, which is these are metrics that help us see how efficiently a bank is using the deposits as well as the assets to generate loans, because loans is actually one of the key businesses of a bank. So we like to see it. So a range of 80-70 is a good thing. So yeah, we can't really complain much. Especially in the loan to deposit, a range of 70-80 there is a good one. 100 is a bit alarming, but yeah, we're seeing currently they're at 86.9 on the loan to deposit ratio. That's quite okay. Asset quality, which is basically the NPL, you've probably heard about the NPL ratios. Very important. The lender's gross NPL ratio improved from 9.5% in 2023 to 9.1%, marking a 40 basis point decline and indicating better asset quality. This is way below the sector NPL ratio of 60.7. The NPL coverage ratio rose from 70.4 to 78. Very, very nice, reflecting an 800 basis point increase, indicating stronger provisioning against NPL loans. All right. The cost of risk ratio, which measures the credit risk within the bank loans portfolio, improved from 1.8% to 1.1%. All right. We can see that the gross NPL ratio line chart, you can see it's on a decline, which is good. Cost of risk on a decline, which is good. And the coverage, which is good. That's more safety right there. So, all right. And over to profitability metrics. return on average assets, you can see it's on an uptrend, as well as return on average assets. These are just some financial ratios that we usually use to just see how things are actually panning out. As well, and an uptick over to cost to assets and cost to income ratios. We can see that cost to income, slight uptick over there from 43.5 to 44.5. Nothing too alarming, but yeah, it's quite okay. It's quite okay. Yield on assets, net interest margin, and cost of funds. We can see that currently is 13.5 on the yield, and cost of funds is currently at 7.9, which gives us a net interest margin of 5.7. And over to capital adequacy, the bank is quite is adequately capitalized, and you can see it's above all the two main statutory minimum core capital requirements, which is a core capital to total risk-weighted assets and total capital to total risk-weighted assets. Yeah, so over to the outlook. Stanbic Bank maintains strong asset quality with an NPL of 9.2, which is quite competitive, to be very honest. The likes of KCB having 19.2. Hope I'm not wrong about the figure, but it's around 19. So this is quite commendable. This is very, very competitive, significantly lower than the sector average of 16.7. However, net interest income declined by 5.1, attributable to the subdued private sector credit in the high interest rate environment. Looking ahead, we, as the CBK efforts to reduce borrowing costs, we expect that credit growth will be stimulated. While lower rates may initially dampen interest income, this impact should be counterbalanced by a higher loan uptake. Meanwhile, political instability in South Sudan remains a challenge, as you have seen the 61% decline in the South Sudan subsidiary bottom line, which is quite drastic. So until we see a stability in South Sudan, we expect that the bottom line, even in the overall Stanbic Bank, will be affected. Additionally, Stanbic's bancassurance arm presents a growth opportunity, allowing the bank to diversify revenue streams and expand its market presence. Overall, we anticipate revenue growth driven by a rebound in private sector credit expansion, alongside emerging opportunities in bancassurance. So, as the CBK has, continuously cut rates and even forced the various commercial banks to fall in line and just cut rates, we anticipate that we're going to see that rebound in private sector credit growth, which will now push net interest income. Will mitigate that because when the rates are lower, the yields are lower, so interest income will be lower. But now we expect that the fact that more people will be taking loans, it can actually be an offsetting aspect around it. We anticipate, our price target currently is 180, which is, if I can go back to the first page, roughly 12.5%, 12% upside. The 160 price. Right, so that is Stanbic, and I think I can proceed to the next one. Just a minute. All right, over to NCBA. I hope it's well visible. Not too sure. Is it okay? Is it still visible?
Yes, visible.
All right, thank you. So over to NCBA, Q4 2024. As you can see, the last price, that was 1st April, which is actually today, was 52.5, valuation estimate around 59.2, an upside of 12.8. So we recommend a buy. And NCBA is well positioned for growth, driven by strategic investments in digital capabilities, as you're going to see ahead as we go through the report, and its strong presence in the asset financing sector, Additionally, the improving profitability of its subsidiaries is contributing to the overall enhancement of the group's performance. All right, so total interest income rose by 16% to 75.7 in 2024 from 65.2 billion, reflecting an uptick of 10.1 billion, owing to the high interest rate environment during the period under review. Interest from loans and advances ticked higher by 27.8% to 46.5 billion, while government securities brought in 5.6 less at 25.6 billion from 27.2 billion in 2023. Interest from deposits and placements with banking institutions came in 123.9% higher, reaching 3.4 billion from 1.5. Other interest income came in 9.8% higher at 174 million from 65. So you can see that total interest income has been on
John, you can use your tab, your host. You need to mute everybody. Yeah? Can you? John?
I'm supposed to mute everyone?
Yeah, you can just go to participants and mute everyone.
Okay. Okay. Let me just do that. Okay, yeah, I've done it. Okay, right. Okay, thank you. So we can see that total interest income has been more or less on uptrend. Interest income growth rate, you can see that in 2024, interest from deposits and placement with banking institutions grew the fastest at 123.9%, followed by loans at 27.8%, and other interest income at 9.8%, while government securities saw a decline of 5.6%. Total interest expense increased by 34.5 to 41.2 billion in 2024, up from 30.6, presenting a 10.6 billion rise. So you see that we had an interest income rise of 10, and we also have an interest expense growth of 10. So more or less offsetting each other. Interest paid on customer deposits surged by 34.5 to 38.2 billion compared to 28.4 in the previous year. Interest on deposits and placements from banking institutions grew by 21.7 to 1.9. Other interest expenses saw the most significant increase, rising by 60.2 to 1.1 from 681 million. Right. So you see the interest expense, the largest chunk is due to customer deposits. Interest expense be paid onto customer deposits, followed by deposits and placements from banking institutions. Total interest expense there, more or less down. Interest expense growth, the fastest one was other interest expense, followed by customer deposits, and lastly, deposits and placements from banking institutions. Net interest income and non-funded income, or non-interest income. Net interest income recorded a marginal decline of 0.3 to 34.5. As I mentioned a few minutes ago, we saw that interest income grew up by 10 billion, and interest expense, as well increased by 10, giving us almost zero. That's why we are seeing the net interest income recording a marginal decline of 0.3%, more or less remaining flat to 34 billion, down from 34.6, reflecting a decrease of 86.8 million. This flat performance was primarily due to a 34.5 increase in interest expense, which offset the growth in interest income. Total non-interest income declined by 3.1% to 28.2 in 2024 compared to 29.1 in 2023. This is a reduction of 895 million. This was largely attributable to a 25.4 drop in FX income, which fell to 6.2 billion from 8.4 in the year prior, which is a decline of 2.1 billion. Right. Conversely, fees and commissions on loans and advances rose 3.2 to 12.3 billion, up from 11.9, an increase of 385.4 million. Other fees and commissions also saw an uptick, rising by 11.1 to 6.1 billion, from 5.5 billion. Additionally, other income grew by 7.2% to 3.5 from 3.3. Right, so total operating income, which is more or less revenue in the banking space, declined slightly by 1.5% to 62.7 billion, down from 63.7 billion in. So the contribution of net interest income, why we actually look at contribution, we want to see how much we are actually affected by interest rate changes. So we basically we just want to see that non-funded income, or rather non-interest income, is also making a good contribution to operating income, which is revenue. The contribution of net interest income to total operating income decreased by 70 basis points to 55 in 2024 from 54.3, while the share of non-funded income declined to 45.0 from 45.7. All right, so there's a chart there. We see the development in net interest income and unfunded income. Operating expenses remained flat, which is quite commendable, decreasing by 595.6 million. Loan loss provision, which is also a very major metric to look at, was reduced by a staggering 40.1% to 5.5 billion in 2024, from 9.2 to 3.7 billion. Staff cost, which is also one of the biggest component of operating expenses, expanded by 10% to 13.4 billion from 12.1, while direct emoluments declined by 10.1% to 275.7 million from 306.6 million. Rental charges rose 14.6% to 1 billion from 904.9 billion. I think that's supposed to be million, while depreciation charges on property and equipment increased by 7.4 to 936.8 million from 872.5 million. Amortization charges dropped 4.2% to 1.2 billion from 1.24. Other operating expenses surged by 12.3 to 15.3 billion from 13.6. Right, so you can see the operating expenses composition, having the other operating expenses covering 41%, while staff costs come in second at 36%. And thirdly, we have the loan loss provision. Profit before tax. So NCBA Group reported a profit before tax of 25.1 billion in 2024, marking a 1.3% decline from 25.5 billion in 2023. Kenya subsidiary remained the largest contributor, generating 15.8 billion, although this represented an 18% drop from 19.1 billion the previous year. As you can see there on the chart right below, you can see 19.1 billion, and now we have 15.8 billion. The Ugandan subsidiary posted 429 million, down 21% from 545 million in 2023. Right, in contrast, the Tanzanian subsidiary recorded a 7% increase, rising to 464 million from 432 million. Right, so we also see the Rwandan subsidiary posted a loss before tax of 130 million, a reversal from the 331 million profit recorded the previous year. So on the non-banking subsidiaries, so you can see down there, it's clearly highlighted 2024 and then 2023. So we see the investment bank segment in 2024 brought in 307 million, which is a decline from the previous year's 454 million, while bank assurance brought in 401 million, which is higher than the previous 292, while insurance, which is now a new wing, brought in 168 million. On the leasing side, we have 344 million, which is more than double the previous year, which is commendable performance. So over to revenue contribution by subsidiary. The Kenyan subsidiary generated 51.2 billion. So basically, we mentioned revenue, we're talking about operating income. Operating income is whereby you add net interest income and non-funded income. So you get the operating income. The Kenyan subsidiary generated 51.2 billion in revenue in 2024, reflecting a 3% increase. NCBA Uganda recorded 3.4 billion in revenue. So you can see there from the chart below, you can see Kenya bringing in 51.2, NCBA Uganda with 3.4, NCBA Tanzania with 2.8, and Rwanda 2.8 as well, non-bank subsidiaries 2.5, bringing us to a total of 62.7 at the group operating income level. So the group's operating income stood at 62.7. All right, and you can see to the right, cost to income ratio, just trying to show us how efficient, because the higher the cost to income, it basically shows us, because it's a ratio of cost to income. So the higher the cost to income ratio, you can tell that operationally they're quite inefficient in terms of the operating costs are too high or the income is too low compared to the costs. So you can see currently Tanzania is quite high on that scale with 71.8%, and the Kenyan business is doing quite well at 49.3%. All right, and at the group level, we see it's 51.3%. So, what is the group level? We are not too bad, but ideally something around 40 or below 40% is to be targeted. All right, over to the digital banking and credit metrics. So digital banking has been a very strong driver of the bank's bottom line. So NCBA Group disbursed a total of 1 billion through its digital channels in 2024, reflecting a 12.6 increase from 932 million in 2023. That's quite commendable. Digital banking contributed 7.4 billion in profit before tax across all subsidiaries, a significant 74% increase from 4.2 billion in the previous year. Quite commendable. The strong growth was recorded in the Kenyan market, where profit before tax surged by 93%, increasing from 2.6 to 5 billion in 2024. Okay, so we see digital Ghana. This is basically digital banking in Ghana. Showed slight improvement with its loss narrowing from 31 million in 2023 to 23.0 million in 2024. Right. So here we see digital banking, a profit before tax. So basically, this is the overall profit before tax that is contributed by digital banking. The reason why we're working with profit before tax is because we're dealing with different regions. So just want to see before we can take out the taxes, how much are we generating from the various regions. So currently we're seeing this is very commendable from 4.3 in 2023 to 7.4. That's strong performance. And digital banking as a percentage of the overall profit before tax at a group level currently in 2024 is 30%. Very strong performance. So you can see how important the digital banking sector is, and that's why you continuously see the banks are in millions, investing billions actually into digital banking technology. All right, digital banking contribution to profit before tax. We have the 2023 and 2024. So more or less very clear, and we see the Kenyan business, of course, is dominating. 2023 did 2.6 billion, and now currently at 5 billion. Good performance over there, but we can see the loss in digital Ghana. But more or less an improvement, as I mentioned earlier, from 31 million, a loss of 31 million to a loss of 23 million. So more or less we're making some strides over there, but they're still in the loss, in the red. All right. So total disbursement, the number of loans that they actually give out. So it's actually on an uptrend, which is very good. Basically, that's just good performance right there. All right, so overall group profitability, NCBA Group reported a net profit of 21.9 billion in 2024, marking 1.9 increase from 21.5, expanding by 409.1 million. Earnings per share definitely will rise in line with the net profit by 1.9% to 13.27. up from 13.02. The board has recommended a final dividend of 3.25 per share, in addition to the interim dividend of 2.5 that was paid earlier, bringing the total dividend for the year to 5.5 per share, representing a 15.8% increase from the 4.75 paid out in 2020, which is very good, because basically most investors, what they want, actually all, just to see an upward trend when it comes to net profit, earnings per share, and dividend per share. As you can see, all in an uptrend. So that's some good news. Balance sheet highlights: total assets declined by 9.3 to 665.9 billion in 2024, down from 734. Kenyan government securities held to maturity fell by 16.8 to 104 billion from 125, while those available for sale saw a marginal 2% drop to 76.8 from 17 billion. Right, so the loan book contracted by 10.4 to 302 billion from 337, primarily due to the high interest rate environment. And now, not many people can afford credit, but we expect to see that change. Customer deposits declined by 13.4, reducing by 77.4 billion to 502 billion from 570. And that's quite a huge decline in customer deposits, 7.4 billion. Right, total liabilities decreased, quite commendable, 12.5% to 556.2 billion, down from 636 billion. Shareholder funds grew by 13.5 to 109.7 from 96.7. This is an increase of 13.1. So this is directly tied to a 19.8% increase in retained earnings, which climbed from 64.9 billion to 77.7 billion. Quite commendable. So we can see the total loans and customer deposits. You can see now that 2023 and 2024, you can see the deposits declined from 579 to 502. Right, but over to some metrics here: loan to deposit and loan to asset ratio. We're seeing the loan to deposit is rising nicely. That is actually a good sign. So we're seeing they're using the deposits. They're able to generate more loans from the deposit, which is quite good. Maybe they should just try and push it further. 60 is quite low. You will find other banks with even 80. So but more or less can't complain much. Over to asset quality, loans declined by 16.6 to 37.2 billion in 2024, down from 44.6, which is very good. The non-performing loans ratio improved by 90 basis points to 11.2 compared to 12. So this decline from 12.1 to 11.2 is an improvement. For non-performing loans are more or less, let me call them a negative aspect, positioning it well below the industry average of 16.4. You can see the decline in gross loans there. NPL ratio declining nicely, as well as NPL coverage picking up, but not too high, but not too low as well. Right, over to the outlook and recommendation. We anticipate NCBA's growth momentum to remain strong, fueled by its expanding digital banking segment. As you've seen, it currently accounts for 30% of the profit before tax, which is very strong, and increasing revenue contributions from its regional subsidiaries, with digital banking now accounting for 30% of the group's profit before tax. This trajectory is expected to continue as the bank enhances its digital offerings to meet evolving customer needs. NCBA's smart network rollout has significantly improved customer access to banking services, expanding its branch network to 199 locations across regions, including 10 new branches in Kenya, Rwanda, and Uganda. Additionally, through its agency banking partnership with Book Bank, NCBA has onboarded for 76 agents in 96 branches across Kenya. The diaspora banking team has also strengthened the bank's international presence, extending its reach to Australia, the Middle East, and the USA. The bank continues to lead the asset finance sector, holding that 5% market share, which is quite commendable, supported by product innovations and strategic partnerships with major vehicle dealers such as Isuzu, CFAO, Simba, and Inchcape, meanwhile, its corporate banking division remains a key pillar of growth with 210 billion deposit base, further bolstered by enhancements to its internet banking platform to uphold asset quality. Its BA is reinforcing credit risk management, intensify loan recovery efforts, and refining lending strategies to maintain a resilient loan book, combined with the continued expansion of its digital banking ecosystem. These initiatives are set to drive sustained growth for the group. Right. So that is NCBA. I will move to the next one. All right, over to ABSA. As of 27th March, which is when the report was done, the price was 19. A valuation estimate of 20, an upside of 5.3%, and thus we recommended a hold since it's below 10%, as well as on the technical analysis side, it was more or less at a high point in terms of structure. So we just try and keep it simple. We don't really like to recommend a buy when we are not really confident in the upside. All right, so Absa Bank is well positioned for continued growth, driven by strong expansion in digital banking. You're going to see a lot of digital banking across the tier one banks. So more or less, you'll see this a lot. Corporate and investment banking and subsidiary performance, all contributing to an enhanced bottom line. All right, so you'll see corporate and investment banking being a very key pillar for Absa. All right, so interest income. Total interest income surged by 19.3 to in 2024, reaching 64.7 billion from 54.3 billion, an increase of 10.5 billion. This growth was primarily fueled by interest from loans and advances to customers, which rose by 20.6 to 53.3 billion from 44.3 billion. Interest income from government securities saw a modest 2.4 year-on-year increase, rising to 9.4 from 9.2 billion. Right. Meanwhile, income from deposits and placements with banking institutions more than doubled, climbing to 2 billion in 2024 from 832.1 million. Right. So you can see interest income is largely constituted by interest income from loans and advances to customers, which is quite expected, followed by interest from government securities. All right, so we can see the interest income trend has been on uptrend, which is good news. And year on year, we see the deposits and placements with banking institutions. That interest grew at 134.5%, being the fastest, followed by loans and advances, which grew by 20.6%. Interest expenses, total interest expense rose by 30.1%. We see interest income grew by 19.3%. Okay, so interest expense grew by 30.1 to 18.5 from 14.2 billion, reflecting an uptick of 4.3 billion. Interest on customer deposits jumped by 15.2 to 18 billion from 11.9, adding an extra 6.1 billion. Interest on deposits and placements with banking institutions dipped by 86.9 to 284.9 from 2.2 billion, a decline of 1.9. Other interest expenses bulged by 49.5 to 256.1 million from 171.3 million. So interest expense largely constituted by customer deposits. So definitely when a customer deposits money, you pay them interest. So that's why 97% goes to customer deposits. So total interest expense was an uptick, more or less expected. All right, so I think let me just jump to the net interest income and unfunded income. Net interest income grew by 15.4. Net interest income is basically net interest income and then minus interest expense. So net interest income grew by 15.4, reaching 46.2 billion from 40 billion in the previous year, an increase of 6.2 billion, quite commendable. This is quite obvious because this was mainly because of the high interest rate environment, largely, during the period. Remember, interest rates were at a high of 13, early in the year. So, right, so over to non-funded income rose by 10.8 to 16.1 billion in 2024, up from 14.5, adding 1.6 billion. This growth was significantly supported by a sharp 273.5 surge in other income. This non-interest income growth was also bolstered by diversified traditional revenue sources and strong performance, from new revenue streams, including payments, lending, asset management, and brokerage services. Other income soared to 2.6 billion in 2024 from 697.6 million, contributing an additional 1.9. Meanwhile, fees and commissions on loans and advances declined by 8.8 to 1.4 from 1.5, whereas fees and commissions rose by 4.5 to 6 billion from 5.8 billion. Foreign exchange FX dipped by 7.1, settling at 6 billion from 6.5. So this brings the revenue to 62.3, revenues operating income to 62.3 billion from 54.6, reflecting a 14.2% growth, which is good. Net interest income contribution to operating income increased by 0.8% to 74.2 in 2024, up from 73.4, while non-funded income declined by the same margin to 25.8. So you can see here that the net interest income has a very strong dominance. Right, the uptrend in net interest income as well as non-funded income. Operating expenses. Total operating expenses increased 5.5% year on year to 32.6 from 30 billion, reflecting an additional 1.7. This was driven by an 11% increase in staff cost, which grew by 1.3. So you see, it's quite close to the total operating expense increase of 1.7. So yeah, it was the largest driver of the increase. Loan loss provision declined slightly by 1.6, settling at 9.1. See this one, the loan loss provision is only 1.6, while another one is 40%, settling at 9.1 billion in 2024 compared to 9.2 billion the previous year. Direct emolument surged by 30% to 255.5, up from 196.5. Rental expenses show a sharp decline, 46.2, dropping to 68.7 million from 127.8 million, reflecting a decrease of 59.1. Depreciation on property and equipment increased by 8.8. Amortization charges rose significantly by 60.4, reaching 222.2 million, up from 138.6 million. Other operating expenses increased by 4.7 to 9 billion compared to 8.6. Right operating income, which is the revenue, grew at a faster rate than expenses. Thus, the cost to income ratio improved by 200 basis points, declining from 39.7 in 2023 to 37.7. So a decline in when it comes to cost to income is a good thing. Right, so you can see the trend in total expenses and an uptrend. More or less due to the inflationary, inflation generally, and expansion and all that. So loan loss provision as well, you see it's flat, which is quite commendable. As we mentioned earlier, loan loss provision declined by a slight 1.6%. Right, profitability. Lender reported a profit after tax of 20.9 billion in 2024, up from 16.4 in 2023, marking 4.5 billion increase, quite commendable. This growth was driven by a strong expansion in net interest income, supported by the high interest rate environment that characterized the year. You can see that most banks really benefited from the high interest rates during the year. Even after the CBK was pushing for rate cuts, they were still reluctant due to various reasons, but they still they really benefited from the elevated interest rates. The board recommended a final dividend of 1.55 per share, in addition to the interim dividend of 0.2 per share declared in October 2024, bringing the total dividend to 1.75 per ordinary share, which is an increase of 12.9%. The total dividend payout for 2024 rose to 9.5 billion, up from 8.4 billion in 2023, reflecting an increase of 1.1 billion. So that's more money for the shareholders. Despite this growth, the payout ratio declined by approximately 6 percentage points to 4.5% in 2024, down from 51.2% in the previous year. Earnings per share uptrend, net profit in an uptrend, and dividend per share as well in an uptrend. Balance sheet, total assets, a slight decline of 2.6. Kenyan government and other securities held for trading purposes surged by 63.7. Definitely, they were capitalizing on the high interest rates at 33.5 billion from 20.4, while Kenyan government securities held to maturity edged down by 1.2 to 1 billion from 1.1 billion. Government securities classified as fair value through other comprehensive income increased 30.4 to 96.1, up from 73.6. Over to the loan book, we see the loan book contracted by 7.9 due to the high interest rate environment, declining to 309.1 billion in 2024 from 335 billion. Customer deposits grew marginally by 1.2% to 367.1 billion in 2024, up from 362.7 in 2023, representing an increase of 4.4 billion. As a result, the loan to deposit ratio dropped from 92.5. As you can see to the right, there's a chart there, 92.5 in 2023 to 84.2 in 2024, owing to the loan book contraction during the period. Nothing alarming there, even though it's a decline, still within the proper range, which is 80 thereabout, which is fine. So loan book by sector, personal household accounting for 40%, followed by manufacturing, and then trade, real estate, agriculture, the least being mining and quarrying at 0.3%, and the NPL ratio, building and construction having the highest, followed by manufacturing at 26.3%. All the way down, we see financial services at more or less almost a zero. Right, so digital transformation. Absa Bank Kenya continues to expand its digital capabilities in line with its strategic objective of becoming a fully digitally powered business. Notably, 84% of corporate and investment banking (CIB) customers are now digitally active, reflecting strong adoption of the bank's digital platforms. Timiza, which is Absa's mobile banking platform, has demonstrated strong performance, with loan disbursements increasing by 21% to 20.7 billion. From 20.7 billion to 25.1 billion, a 4.5 billion growth. Quite commendable. This now represents 8.1% of total loans disbursed in 2024, up from 6.2% in 2023. Additionally, Timiza's revenue expanded by 46.0%, while digital savings on the platform surged by 67%, reinforcing its growing role in the bank's digital ecosystem. Digital transactions continue to dominate, with volumes increasing by 7%, rising from 86.5% of total transaction volumes, which encompasses both branch and digital, in 2021 to 93%. So we see that digital transactions, are really dominating. You can see it in the numbers. We'll get to the charts. Digital onboarding is also gaining traction, with 28% of total customers now onboarding through digital channels. That is quite good, further underscoring the bank's digital transformation agenda. The Wezesha stock platform, launched in 2023, has also strengthened Absa's SME proposition by facilitating unsecured working capital access and enhancing inventory management capabilities. This aligns with the bank's focus on SME growth, further contributing to revenue expansion. In support of its digital acceleration, Absa has invested 3 billion in core banking modernization, automation of back office operations, and digitization of key customer journeys, including onboarding and lending. This investment enhances operational efficiency, improves customer experience, and positions the banks to scale its digital-first approach. So it really is a lot of money. So that continues to show us how significant this digital banking area is in the entire commercial bank space, right? So you can see that the transaction volumes are growing from 86.5% to 93. So the digital banking side is actually taking the largest share of the transaction volumes, which is quite commendable. That's why you can see them they're very comfortable and confident in investing a whole 3 billion shillings in the digital banking modernization. Timiza loan disbursements, you can see an uptick from 20.7 there, adding 4.4 billion and closing at 25.1. Asset quality, gross performing loans increased by 20.5 to 42.5 billion, up from 35.3 in 2023, which is an increase of 7.2 billion. So we see the NPL ratio, which is a very important metric, climbed from 9.6 to 12.3. But nevertheless, this is still 4.1 percentage points below the industry average of 16.4%. So more or less, even if you were to compare it to a company like KCB, which has around 19 there, so they're still okay. And the NPL coverage ratio declined slightly by 20 basis points to 66.0 in 2024, down from 66.2, more or less. That's fine. That's nothing alarming there. NPL ratio an uptick there, 9.8 to 12.6. NPL coverage currently at 66 on that chart to the bottom right. I'll proceed to other metrics. Yield on assets, net interest margin, and cost of funds, which are all related. So we see we're currently at 14.5, and then you can see the cost of funds at 4.9, which brings the net interest margin to 9.6. Profitability ratio is more or less flat, but on a slight uptrend. Profit margin, which is actually, I think, easier for people to understand, which is a very strong metric, simple but very strong. You can see the profit margin is grew from 29.4 in 2021 and currently at 33.5%. Right. So over to the outlook. Absa Bank is well positioned for continued growth, driven by a strong upward trajectory in revenue, supported by a robust non-interest income and net interest income and non-funded income expansion. Prudent cost management remains a key pillar in preserving margins and sustaining solid bottom line performance. The bank's asset quality also remains resilient, with the NPL ratio of 12.3, which is significantly lower than the industry average of 16.4%. Amid a high interest rate environment, management observed a shift from long-term lending to bridge financing, which means bridge financing is basically short-term loans instead of the longer period loans. Let me just reread the sentence. Amid a high interest rate environment, management observed a shift from long-term lending to bridge financing as customers sought shorter-term credit solutions. Timiza, Absa's mobile banking platform, continues to be a key driver of digital growth, recording a 21% increase in disbursements and a 46% rise in revenue, underscoring the strength of the bank's digital banking segment. Looking ahead, the CBK dovish monetary stance is expected to exert pressure on the net interest income as yield decline across the board. However, private sector lending is anticipated to gain momentum, as I mentioned earlier in the other bank report. In the medium term, as the Apex Bank's rate cuts filter through the economy, this increased credit appetite will drive loan expansion, partially offsetting the impact of lower interest income. As I mentioned again, Absa Bank Kenya remains on a strong growth trajectory as it continues to execute its digital transformation strategy while deepening its focus on the corporate and investment banking segment. So yeah, the upside there is we're looking at 20 shillings, and at the time of writing of this report, the price was 19. So a shilling more or less, but it's more of a hold. So if you're not already a stakeholder or shareholder of the stock, we don't really recommend buying at the moment. But yeah, that is subject to change. So that will be all from my end. I think I'll ask my colleague Gugi.
Yeah, thank you, John. I think now we can introduce any questions listeners may have. I'd also ask the host to let me share my screen where we can leave our details. I think I'd also like to point out that currently the dividend yields as they stand for the banking sector, StanChart leads the way with 12.4% dividend yield, followed by Stanbic at 11.7%, followed by Corp at 9.4%. DTB, unfortunately, our DTB presentation was corrupt, so we couldn't share it, but please do reach out to us on our emails and I'll send you the whole package that we have done today. But DTB was at 9.2%, followed by Equity Bank at 9%, and then followed by ABSA at 8.2%. That's also the top currently. So yeah, any questions, feel free to put them in the chat box, or I'm seeing the chat box.
Yeah, thank you, Ngugi and John Collins. Thank you so much for the presentation. Yeah, Daniel here. I have a few questions. They were submitted earlier, so as the community continues to post other questions in the chat box, so I'll just ask these questions. I will frame the questions from the economy perspective, sector perspective, and then get to the individual stocks. Now, the deposits across all the banks seem to be declining. We're seeing an average decline of around 3% across all. Would we say these monies are moving to the money market funds? Because we have seen many banks, Stanbic being the last entrant in the asset management division, creating this. We have also seen the holdings of government securities by retail investors jumping from 300 billion to 700, currently around 700 billion plus. Is this where deposits are flowing to? That maybe you can take turns to answer the questions. Go. I ask all of them. What do you think? What do you like, Ngugi?
I think one by one is easier. Sorry, you're breaking up on the first one, so I didn't quite get you. I just heard the end of the.
Actually, the deposits are declining, and we are seeing the assets by the unit trusts, including money market funds, are increasing. The banks are also now, the majority of the banks are setting asset management division and providing money market funds. Is this where deposits are moving to? We have seen government security holdings by retail investors moving from 300 billion to around 700 billion currently. Is this where deposits are moving to? And how would that impact the banking in the long run?
So yes, I know for StanChart when we had the investor briefing, they did allude to that yes, more people are moving money from deposits into other alternative investments like MMFs, special funds. So we're seeing a lot of movement there, especially now with interest rates coming down, and everyone's opening everyone's trying to diversify. So in essence, yes, we are seeing people pushing money to not banks themselves, but the customers are now moving into other asset classes, different investments. So banks are trying to catch up with that by now offering their wealth management services, insurance. They're trying to see how they can best diversify their base.
Yeah, good. Thank you. Now, related to that, the loan book also are declining. Of course, maybe interest rates on loans were high in 2024. Majority of the people were opting not to do loans. We had SACCOs, which reported also. Could we be seeing now popularity around SACCOs where majority of individuals moved to borrowing from the SACCOs? What could you say about now, maybe like the whole sector in terms of the loan book?
Yeah, we definitely saw increased pressure on the loan book. Private sector lending declined, given the interest rates and the economic environment. People weren't too keen on loans at the moment. As we can see, businesses are struggling. Everyone is struggling with cash flow as well. So people are more interested in SACCOs. I believe SACCOs have, a different way of loaning. They give you maybe 3.3 times or something your shareholding. So I guess people are finding it more lucrative to look into SACCOs than the bank. So that definitely puts some pressure on the bank. But I'm sure with the rates coming down, most banks, as we know by CBK, have been forced to lower their rates. So we should see some loan book growth, hopefully with inflation a bit more muted now, and the rates coming down. We're expecting to see some pickup in private sector borrowing. But as I said, we can't tell how much it will be, whether it will be enough to offset the declines that we saw this year. But most banks are positive that their loan books will grow as per the investor briefing. So we can only wait and see.
There's the core capital requirement by CBK. But any listed bank that could be impacted, and John has a question. Should he worry if one of the banks that could be impacted by that, the minimum core capital requirement, like if he is a customer of a certain bank and probably the bank is forced maybe to be acquired or something. So any listed bank that could be impacted, and what would be the implication for people who belong to those small banks, the likes of Orient or whatever?
That's a good question, actually. I hope I'm audible enough.
Yes.
So, concerning the core capital requirements, so what I would actually say is the market is expecting disruption once the phased in the core capital requirements start to be enforced. But what I would say is I don't believe that there is a bank that will be, for example, if I'm a client of a certain small bank, for example, Consolidated, because what will actually happen once now the time has elapsed for the first phased in time, acquisitions will have to happen, mergers and acquisitions. And when such a thing happens, definitely it's the tier one banks that will be in play, or maybe some foreign players. But in terms of losing your assets, I don't think that's on the table, to be honest.
Okay. Thank you so much, John. Nani, just a minute. I'm reclaiming the host so that I share something so that I can be able to make this question better, kindly.
No problem.
Okay. Okay, good. So this is now is in regards to KCB. The total full year EPS, that is the earning per share, is at 19 shillings. That is how it looks like quarter per quarter. So maybe the background onto that. So there was the G2G deal, that is the government to government deal, and there was also the currency fluctuation. And in quarter one, KCB reported a good performance. Now, of course, having made quite some significant amount of money, especially from the FX. And now, how we do our valuations is the trailing 12 months. So now, if we replace this quarter now, the quarter one 2024, by what we expect in quarter one 2025, if it is not as good, because where does G2G come or something? Actually, they are seeding part of the G2G deals. I don't know where the volatility would come from the FX or something. How do we is this a risk in regards to the valuation of KCB? I don't know. Maybe somebody can make a comment. Google or John. So yeah, come Q1 data, and then we are doing our 12 months training, EPS, so that we do evaluation. Then you can expect that valuation to significantly be impacted. Would that be a risk in regards to the share price? How would the market react to that?
Yeah, I understand what you're saying, but KCB is such a behemoth of a bank that I don't think the share price will be affected as much. I think they still hold quite a large share of the market. So even if they cede shares in the G2G, I do believe they're still poised for a good performance. Though I do see the trailing. I see what you're saying with the trailing decline, and I agree with it. But we can only wait and see what track it takes.
Okay. No, I think it was yesterday's Business Daily, and Nani CEO Mwangi was explaining the usage of the retained earnings. So once we do the distribution, so yeah, they're saying, yeah, equity has a low distribution rate, but this is how we are using money. Some of the subsidiaries now are seeing them reinvesting capital there, and some of the subsidiaries are seeing growth, significant growth. I'm asking that question to ask the question of DTB, whose distribution rate has been at 23 in 2022, 24% in 2023, 25% in 2024. Where has DTB been investing, like the retained earnings?
I know DTB wanted to really expand, so I think they're putting their money into expanding. They wanted to grow their presence both regionally and locally here.
Okay.
As well as digital transformation. I saw a question in the chat about it as well. Everyone is on getting digital and reducing operating costs. I mean, that's where we're going. In the age of AI, do we expect OPEX to decline across the board? We do it. Well, it's a long term. The long term, we do expect that, but initially, due to increased investment in tech and some of them expanding to grow their retail base, we will see first a rise in OPEX before it evens out.
Okay. Thank you so much. Nani Karaoke, CEO Standard Chartered, was saying that regarding the cases, especially regarding pension, they are creating contingent. They are looking at it as a contingent liability. The meaning of that, and maybe the impact if the case against their favor.
If the case goes in their favor?
If it doesn't go in their favor, like how this contingent liability. Yeah, of course, they have lost in the High Court.
Yeah, and they also went to the appeal and they lost again.
Okay. How does that impact the Standard Chartered?
Those figures are big. I think it was 9 billion or something crazy like that. So billions are not small figures, so it will definitely impact the bottom line. I'm not too sure how they've provided for it in terms of whether they'll make a provision for it or if they had in this books, but we should see an effect.
Okay. Now we have young members in the call. How does one get so good at analyzing financials? So for those people who maybe want to pursue a career in the investment banking or as an analyst or advisory, what would both of you, would you guide in regards to the same? You can start with Google.
Just be curious. I think it has a air of curiosity to it. Get in touch with more financial statements. Get your accounting right. I think your accounting is one of your biggest assets in this field, and then the rest kind of flows. The rest is, why did this happen? How does this affect this? It's a chain. So if you get your fundamentals, especially accounting, down, you should be poised to do the research.
Thank you. Jacqueline is asking which bank is better to take a loan from in terms of the percentages and everything, DTB or Equity. I don't know who would want to answer that.
Unfortunately, I cannot answer that. I'm not in a position to give commercial loan advice. I do not work for any of the banks.
Okay, thank you. Thank you so much.
Yeah.
From the presentation, you have been mentioning about other income. So we'll assume this is Mutuli. We'll assume this is non-funded income. Are they incomes individual investors can invest in them? Maybe John had said if there's something that will be mentioned in the call, and maybe you can just in brief the non-funded income. So there's somebody who was wondering what is this income, and maybe can an investor invest in them? Somebody.
Kindly, I haven't really understood. You mean the components of non-funded income?
Yeah, so you have been talking about non-funded income. Maybe briefly you can tell what it is so that maybe somebody can understand what that is.
All right. So basically, so in a bank, let me just try and break it down from the top. So the main way that a bank makes money is through interest income, right? When they give you a loan and you pay interest on it, right? And now on the other end, we also have non-funded income, or rather non-interest income, which is non-interest as it's said. So for example, you have a mobile app, you're transacting from your phone to M-Pesa. So there's a charge. You're transacting 5,000, you see a transaction fee of 45 shillings, for example. So such things, fees and commissions are a major part of non-funded income. Yeah, I think that really answers it.
Okay, thank you so much. So yeah, Googie, you can share the contacts, maybe for somebody that have maybe the host again. For anyone who would want to reach out, you can tell us about as you share the contacts, you can tell us about your brokerage services and all that. So, Googie.
Yeah, thank you, Daniel. So we as Faida Investment Bank, we deal with equities, government securities, and we have recently launched a special fund, a collective investment scheme called Oak Special Fund. This is a fund where you can lock in your cash for six months, and we have a target rate of about 18%, but a minimum lock-in of 6 months and a minimum deposit of 500,000. It's what a lot of investment banks are turning to nowadays. I'm sure you guys know of a few other funds, so we've joined the bandwagon, and so that's what we do at Faida. We also do transactions. We can help with USP listings. We're located in town at Windsor House, and we're also located in Crawford Business Park along State House Road. So feel free to walk in or reach us on our contacts shared on the screen. And if you have any investment advice you'd like, or if you're looking to venture into funds or equities, securities, we can help you there.
Thank you. Santa Sana. Maybe if there's any question.
Oh, sorry. I've seen one in the chat about, I think we answered one, the NCBA AIG marriage. Essentially, it's just to join the bandwagon. We've seen, I think, Corp have a bank assurance arm, Equity have an insurance arm. So NCBA decided to go with already established insurance company, AIG. So it definitely makes them more competitive. It diversifies their income, spreads their risk. So it's been a trend amongst the banks going into other streams. So I think that's NCBA just keeping up and staying competitive.
I think
there is another question. There is another question there about the fees on the Oak Fund. Maybe if you haven't. Okay. And John, go ahead.
Yeah, I think just to add on to what Ngugi has mentioned, I think you also saw the KCB purchasing, what's the name again? Riverbank Solutions Limited. Kenyan financial technology firm. Yeah, so we're seeing this tier one banks are really trying to just diversify their revenue streams. Yeah, so that's a trend that we're going to see going forward. As interest rates are going down, you're going to see them try and just diversify their revenue.
Thank you so much. And I think we will share with the community. Ngoge, you can answer the question.
I believe it was about the fees.
The fees on the fund.
The fees charged 6%. We charge a 6% management fee per annum, prorated. Right now, our minimum investment, as I said, is 500,000. Minimum top up is 50,000. Our minimum lock-in period is 6 months, and we currently have 2.1 billion assets under management. So we're targeting about a return of 18 to 20% net of fees, meaning after we've already deducted your 6% management fee, our 6% management fee. I can share a fact sheet with you, Daniel, to share with the community if that's something they'd be interested in.
Yes, sure, I will, and you can also you can share these contacts so that anybody who wants to do brokerage can always reach out to you. Now, before Nandu comes to close the session, our moderator, I just have maybe a few things to say. So mid the May, we will have an offshore webinar. That's what we'll be talking about investing offshore. End of this month, April, so we'll have an insurance. We'll get to sit down and talk about the insurance products. So we are looking forward to have a product development manager and somebody from the insurance regulatory authority just to talk about the catalog of the many products that are there in the insurance. So a sales rep tells you about maybe a specific product, but we want to understand maybe the different products and the solutions they can create you. And end of May, we have already made whatever. We'll have arrangement for that. We'll have a retirement planning webinar. So I look forward to all that. So Nandu, go ahead.
Thank you. I'm seeing Catherine has asked a question in the chat. Maybe you can just answer that question, then I can close.
Ngoge or John, there is a question there.
So I'm saying, is the OC 6% charged on the money invested or the interest? Actually, it's on the interest earned. So basically, if we do a certain percentage, when we talk about our target, we're targeting 20% net. So when we give you 20%, we have already deducted the 6% management fee. I hope that's clear.
Okay, thank you to our facilitators, Gogi and John, for the detailed presentations. I'd like to also thank Daniel for facilitating the Q&A and for everyone that has participated. Thank you to everyone for joining this session, and hope to see you in the next sessions, and have a wonderful night.
Thank you. Good night. We are glad you had us. We hope we shared something that people can take away with them.
Thank you so much.
Yeah,
thank you so much. Have a good evening.
Thank you.
Thank you.
Yeah. Thank you very
well
much.
done on the presentation.
Thank you very, very much.
Thank you, Asante.